Hey guys, welcome back to the Saskatchewan Real Estate Podcast. This is going to be part 2 of our conversation with Richard Canfield as we continue to explore the idea of the infinite banking concept. Hope you enjoy.
This is the Saskatchewan Real Estate Podcast, the show that highlights Saskatchewan real estate. Looking to buy your first house, your next investment property? Subscribe to never miss an episode. Here's your host, Ron Caroni.
All right, Richard. So if we're looking at what the prepayment of, or not the prepayment, but the payment back of the loan that we're taking against our infinite banking account, what does the payment back into the account look like and how is that structured?
Yeah. So this is where really, again, the control amplifies. So you as the policy owner have complete autonomy over that. So go back to the unstructured loan. That's not something people are commonly familiar with because every loan that we're used to getting in life is structured in some way. It has a structured amortization, interest rate, payment terms. These are the part of the structure that we're familiar with when you get a car loan or a mortgage or whatever. And so you even in a mortgage, you want to overpay. Well, then you always have the quote unquote threat of a penalty if you pay too much, et cetera. So these are things that really keep people at bay and at odds with understanding the mechanisms of control they have over typical lending environments. In an unstructured loan scenario, you literally have complete control. There is no payment requirement. If you don't pay anything back, obviously interest will accumulate. So it's to your best interest to pay things back. But just like you can have a home equity line of credit, if you pay down the line of credit and you still have access to the line of credit, you can access the money out the very next day and go do something else with it. So as long as that instrument is in place, and it's not taken away from you, which just all things being mindful, circling back to the financial crisis in 2008, there was a lot of people who had home equity line of credits because the markets went down. Those were frozen and converted into principal and interest mortgages because they're on-demand loans. So just be mindful of that in times of economic turmoil. That sort of thing can happen because precedent has already been set for it to happen. In the insurance company scenario, none of that's possible. This is an unstructured loan. You're able to access whatever 90% of whatever the equity, the cash value is in your contract on any given day. Now, typically they might have like a $500 minimum that you need to take, but it's very simple, and the money can be direct deposited into your regular bank account. Yeah, typically within 5 to 7 business days. Sometimes a little earlier, maybe a couple of days late if it's a holiday. So in a relatively short period of time. So we encourage people and we teach people based on Nelson's concept, what he talks about in the book, and he really goes to some degree on this. He has primary understandings about the importance of paying yourself back. And you should be paying yourself back at least what you would be paying some other lender for the same usage of money. Ideally, you would pay more than that, because if you pay more than that, the loan gets paid off quicker. You're actually saving more money than is going to walk out the door to Tim Hortons and other frivolous things that probably happen in life. And you're increasing your capital base so that you can do more projects. So really, it's a lot of this is mindset oriented. It's less about the tool, or, again, when I used the chainsaw analogy earlier, it's less about the tool. It's about the user. How is the user interacting with their system? And that's really where we spend all of our energy and our focus is on working on the mindset. So as soon as if I make a payment of $1,000 today on my policy, well, I can access that $1,000 again the next day, because it's just like a line of credit. It's just that it's not located at a brick and mortar bank. It's located at an insurance company, and it's a direct relationship of the cash value that's there. In fact, on most of my policies, if I put $1,000 in, I can access more than $1,000 because the policy increased at the same time frame. So even though I'm paying quote unquote interest to the insurance company, I co-own the lender. They have to put the money to work for people just like me. They share their profits with me every single year in a dividend, which also makes my system grow. We won't get into that today. And the result of that behavior is when I borrow from them, they're also growing my money at the same time because my money never came out. So I use a little analogy here, and I know maybe folks on Spotify and stuff won't see this, but I've got a giant water jug here, like 2 liters of water I'm supposed to be drinking every day. We'll see if that happens or not today. And then I've got a coffee mug. So obviously the coffee mug is much smaller than the giant water jug. Well, I always ask people, okay, well, if I want to borrow money from my insurance contract, where does the money come from? If my money is the coffee mug, all my money is represented here, and I've got this giant pool of water and this big water jug, that's the general fund of the insurance company. When I access a policy loan or a request one, which segment does it come from? So it doesn't come from the coffee mug. My money continues to grow uninterrupted. It's never touched. Instead, it's collateral, and I get my money from the insurance company's general fund, which is why my money continues to grow uninterrupted for the rest of life. The only thing that stops it is if the policy owner chooses to cancel the policy, which is their voluntary decision, or somebody dies. And if somebody dies, boatload of tax-free money shows up, pays off the loan and any interest anyhow, and it takes care of an awful lot of problems that most people leave behind.
You had touched on a secured line of credit or a home equity line of credit. And that was kind of one of the things I wanted to touch on, because it did have, to me, a lot of similarities to that, in that you touched on an important point there of front-loaded mortgages and how mortgage payments are structured with a traditional mortgage, where a home equity line of credit is just, you have the money. If you take money out, you start paying that interest rate on it, and you do have access to it at any time. So there did seem to be similarities for me. But would you say the biggest benefit of the infinite banking style of that is that you still have more control over it than what you would see in a home equity line of credit?
Yeah, so they are very similar in nature. You could, use the analogy that the policy loan is like it's like a home equity line of credit. It's just attached to contract property instead of physical property. Okay. The differences are here. Number one, to get the home equity line of credit, you have to be able to be approved for one. Number one, you have to have sufficient equity in the property. And, if we went 20 years ago, you could have got 80% loan to value on a line of credit. Well, now you can only get, in most cases, 65%, and 15% balance has to be in a principal and interest mortgage component. So they changed the rules. Changing the rules is a common feature of the lending industry, especially in times of uncertainty. Any real estate investor knows, and any realtor knows, that, the mortgage rules shift actually pretty regularly. And what one bank was doing a week ago, they're not doing the next week, because that shift happens. The general population doesn't always see that, but if you're in the real estate game, you see those things pretty frequently. So the bank giveth and the bank can taketh away. All right. So the control is not at your level. Plus, if you access money from that line of credit, there is an automatic interest-only payment that's required. In the insurance company realm, there's no payment required. A payment is suggested, it's preferred, it's strategic, it's recommended, but it is not required because it's unstructured. There is never any requirement for a payment. So if we never send a payment back, then we, the policy owner, is actually to some degree defeating the purpose of the system, but they're not really being a good banker. So we need to have good financial habits, and we have to have the right mindset to implement this in our life. So it's not an investment vehicle. It's a savings and borrowing vehicle. It's a vehicle that we can use the same way we're using current regular banks in our life. We're just replacing who's in the driver's seat of the money. And by the default of doing that, you can create more efficiencies in how you operate. I'll give you a quick example. I had a client reach out to me, it might have been yesterday actually, and she had a couple of existing insurance contracts. I asked her to phone the company up and make ask a few questions. Just by changing from a monthly to an annual payment on 3 insurance contracts, she saved $1,000 a year. Well, the insurance company didn't do anything differently. And because she switched to annually, the insurance contracts she have will also be more efficient for her based on the type of contract that they are. So now, young girl, 37 years old, what's $1,000 a year plus some earning potential for the rest of your natural life? That's not a small win. That's a big win, because it's over time that accumulates. Now she's going to be able to do that in several other areas of her life. That was always available to her. She just didn't know it. So what we're doing is we're teaching people and exposing these little truths that are out there in the world, and then helping you get mindful and clear on how to capture and harness those pieces of efficient potential that have been naturally walking out the door. And the more and more we do that, the better and better it is for you.
Let's talk about term insurance versus whole life insurance. And someone will say that as opposed to making a bigger premium, I just want term insurance that's going to cover me for the time that I want life insurance or disability. And I'll just reinvest the rest of that money however I may. What would be your counterpoint or your discussion on whole life versus term?
Well, I wouldn't necessarily have a counterpoint. I would ask people questions to think about it. And so here's a couple of points. Number one, the idea of buying term and investing the difference has been a popular idea for a lot of years. The problem is human behavior. Most people buy term and they spend the difference. And so if you spend the difference and you don't invest the difference, you heard the theory and you thought about it. And maybe there was a couple of years that you did it. And then you had kids. And then there was the hawker and the soccer practice. And then there was the job loss that happened during COVID. And then there was this thing and then that thing. And the transmission went on the car. And these life events that kind of kick us in the nuts tend to take us out of the game. So that creates a problem. And then it creates a compound ripple effect problem, which means if the goal is to be quote unquote self-insured out into the future, you're not self-insured. By the way, I've been meeting with clients for 14 years. I can't think of a single one that's followed that advice and actually created the outcome they're supposed to. Not one. Not one. So is it a good strategy? Well, I mean, it could be if you actually follow through on the strategy. The problem is your follow through. The other thing is it's all hinging on some kind of a market return. Well, we don't control the market. This year, if you're in the market, you might be down 35 to 40%. Hey, people that are invested in First Republic Bank in the United States are down 75% this week. You can't control that. It's not up to you. You can't control the presidential or the prime minister election. These things have a direct correlation to the market risk that you face because it's not just market risk, it's geopolitical risk, not within your control. Interest rate risk, not within your control. So these fundamental factors, you're putting everything on a hope, wish, and pray model versus a model of guarantees, access and control, liquidity. They're very different. You can't really compare them because you're comparing an apple and a steak. Like they're not even the same food group. They're not both fruits. They're just completely, totally different animals. And what amplifies that is the way that we think about them. Here's the other problem that happens with term insurance. You buy term insurance, and at the end of the time, their term is up. It's like renting a house for 10 or 20 years. Well, no landlord is going to go to the 10-year mark and say, oh, geez, you've been here for 10 years. I guess I'm not going to increase the rent. The landlord's going to jack the rent, right? When the lease is due. They're going to have to. And so if you're 10 years or 20 years older, actuarially speaking, the cost to deliver that same amount of insurance to you must go up. There's no other way to make it work. There's no such thing as free. So you're renting the benefit for a period of time. Well, when the rent is due and it's time for that rise to happen, people get hit with a premium notice that is typically 350 to as much as 700% increase. And if you've been making a $50 a month payment and it jumps up to $350 a month, what are most people going to do, Ron?
Cancel that policy.
They're going to cancel that policy. Who got all the money?
The insurance company.
Wouldn't you want to own one of those? Didn't you see how profitable that is? There's nothing wrong with the term insurance. It's good. You need to protect your family. Absolutely do that. Don't ever hesitate on doing that. Ever, ever. You should always do that. However, renting a benefit is not a financial strategy. It's a temporarily instituted thing for specific usage of protection. It's not bad or good or otherwise. It just is. But it is not a financial strategy. And so when that jump happens, and if you haven't paid the mortgage off, if you haven't set aside the equity and other things that you need, you kick the bucket. What is your family left with? They have to sell everything off. They have to sell it off at an unknown market condition. What happens if they need the money right away and the markets are down? It's not a good time to sell the money. So everything gets sold at liquidation, which means a lot less is available for the family that you love and care about. That's just completely ludicrous, in my opinion. And it happens all the time. Here's another thing. Have you ever met somebody who was perfectly insurable one day, and then a week later or 10 years later, they were uninsurable because they had some kind of a health scare happen? Do you know anyone like that?
Oh, yeah, for sure.
Okay. So there's the expression, would you rather be looking at it or looking for it? Well, if you've got the term insurance, first off, you might be able to convert that, which is great, which means you could take that term that you locked in, your insurability, part of your future insurability, and you could convert it into something that actually will be there and last. But if you don't have any insurance at all, and now you're uninsurable, which by the way is happening for people who are younger and younger all the time. I see it all the time. It's really sad. You are gambling away your tomorrows is what's happening. Don't gamble with your tomorrows. You need them. You don't want to go down to Vegas and throw all your tomorrows on the roulette table. It's not a smart strategy. The house always wins. Does that make sense? Take the control back at the you and me level. It's simple and it's easy to do. And it's not difficult to get started. But it can't happen overnight, and you need to have some education. Without the education, it's kind of like buying a piece of real estate and not using a professional to help you if you've never done it before. It's kind of like investing in real estate and not knowing anything about how to deal with tenants, find tenants, what's a good area, what's a bad area, what you're having a home inspection, understanding some of the risks. It'd be just like doing all those things. You wouldn't do that. It's not rational. You need to have some understanding of what you're doing. This is no different. Take the time to get educated. That education will pay off in spades for you over every future year of your life. I'm going to say one last thing on this real quick. We teach people about family banking meetings. My daughter is 5 and my son is 7. My kids understand that we have a family bank. They know, and I asked my daughter, I said, hey, honey, we go on a vacation. When we take money for the vacation, what do we have to do? She says, we have to put it back in. Boom, high five, big hugs. Why is that, Nora? Why do we got to put it back in? So we can use it again later, Dad. Boom, high five, big hugs, big hugs. Awesome. Why is that important, hon? She says, well, we have a family bank. We have to be responsible. So at 5 years old, she understands these things. My kids, my hope, and I believe it won't be difficult for me to accomplish, is that my children will never, ever, ever need to see a traditional bank the way that we are familiar with for the rest of their natural life. They'll come to the family bank, and they will pay interest to the family bank. But every dollar they pay in is a dollar they're going to get back when Dad's gone. So it's a self-fulfilling cycle, and we've taken back control of that entire financing environment for all of major life expenses: weddings, cars, education, down payments on homes, mortgages on homes eventually, computers, cell phones, all of these things that we're going to suck money out of our life. We're going to contain and harness the power of that money. That's what's happening in our family, and it can happen in yours.
You made that sound like such a mafia Don family. It stays in the family.
It's funny to do that though. You're true, but that's funny.
My kind of last question to you, and I don't think my mom listens to the podcast, so I think I can get away with this. My mom, for her whole life, did not believe in anything credit related. And one day when she was approached at Extra Foods to get a credit card, she said, what the heck? Why not? My mom is financially very well versed, very smart lady, but because she had zero credit, was not approved for the Extra Foods credit card. Now, with infinite banking, a lot of this does sound like don't have any credit attached to these other institutions. Is there a thought, or is there an idea that by not having a mortgage at a traditional lender, if we don't have any credit cards, that you're not going to have a credit history? And then in the future, if you did want to access any of those products, that you're not going to be able to? And is the plan just to be able to have enough funds available in the infinite banking account that you don't need to have access to that? Or what is the stopgap?
So you kind of answered the question in that last statement. So it's not that we don't want to have the ability. You want to have I'm all about flexibility and options. I don't think you want to take any of your options away. Okay. The more options you have on the table, the more empowered you are, especially with knowledge, to make decisions that are appropriate for you and your family's life. So that's just sound thinking. And so if you want to be able to take advantage of opportunities will always appear to those that are well capitalized. In other words, if you have readily available access to money, the size and quality of the opportunities that show up for you increase incrementally to the level of capital you have access to. Does that make sense? It's this weird thing that just happens. The more and more you build up reserve of capital, the better quality of deals seem to show up for you. Okay. Deal flow is easy to find, but then being able to harness and understand what those deals are like is different. So banks use other banks all the time. They do overnight lending. There's no reason that if you have your own system for the purpose of controlling the banking function in your life built up, You can't go and tap into someone else's bank. Of course you can do that. And there might be viable reasons to do that. But you want to be in a position that if they change the rules or the market shifts in a way that you don't like, you can fire those guys in a heartbeat. So you're still going to want to build your credit and do all those same things, but you want to be positioned in a level of strength and control to dictate the rules and the outcome. See, the banker is the person that makes the rules. They decide, do you qualify for the loan? What's the interest rate? What are the payments? Should they give it to you? That's the banker's role. Well, when you are your own banker, you need to play that role. And it's something you haven't been trained to do, which is why you need training. So we coach people on how to do that, to understand how to control and do this in their life. And we have an online membership for our clients that has probably 50 some hours of content in it. We have regular quarterly client coaching where our clients all over the country are invited to come in and participate, to learn from one another and network. We have 2 YouTube channels. We probably have 700 videos available at present for people to dig into. I mean, it's all about getting the information to the people so they have the ammunition to make good decisions.
If I could probably put a synopsis on that, it's that options are never going to hurt. And this could just be another great bullet in the gun if you need to fire it.
I would say it's the silver bullet. Yeah.
Wonderful. If you got the werewolf coming at you. Very nice. Richard, this was really illuminating, and there's lots of excellent information in here. And first off, thanks for coming on and sharing all this information. Last question to you. I like to have everyone who comes on the podcast answer this. It is, if you could go back and give a young Richard some advice, what would that advice be?
Ooh, that's dead easy. I would have told Richard at 18 to go and buy this book, Becoming Your Own Banker, and read it.
Simple enough.
Expose yourself to a new way of thinking. And I was 11 years late to the party, and what I could have and be working with in capital now, had I known this earlier, considering how much money flowed through my life over that decade period of time, I can't even imagine what the difference would be. Can't even imagine.
If people are interested in getting more information on this concept, Richard, how can they get in contact with you? And what are some of the social media and streaming platforms where they can find more info?
Yeah. So, I mean, best bet is our podcast, Wealth Without Bay Street. We've got about 160 episodes or so at this point. We have a client series available there. You can go to wealthwithoutbaystreet.com/client series. It brings you right to the playlist. And we have a free report, a white paper you can download. It really walks through the 7 learning steps, the 7 required things you need to do to decide if this is even the right fit for you or not. And that's 7 steps. That's 7steps.ca. Very simple. Go and download it for free and read through it. It'll walk you through the recommended learning journey to really determine, is this something you want to do? And if it's not, that's perfectly fine. But you can't say that if you don't even know it's available.
Awesome. Thank you so much, Richard. It was really nice chatting with you. Just thanks again for coming on the podcast.
Happy to be here. Thanks, Ron. Appreciate everything you do.
Hey guys, thanks for checking out this episode of the Saskatchewan Real Estate Podcast. I hope you found some value here. And if you did like what you were hearing, make sure to hit the like button, and to never miss an episode, subscribe. We air weekly episodes just for you. If you are in the Saskatchewan market and you are looking for a purchase, a renewal, or refinance of a mortgage, I'm more than happy to answer any of your questions. My details can be found in the links or descriptions of this video or audio podcast. Until next week, my name is Ron Caroni, your Saskatchewan mortgage professional. Bye for now.